basically what I'm going to cover in the next 40 minutes, we're going to look at tax planning strategies. Briefly, we're going to look at VAT, and then we're going to look at tax jurisdictions. Okay, 1, 2, and 3. This is what our goal is for the next 40 minutes. We want to go through that very, very quickly. We know we've got a group presenting tonight, but we really want to give you some ideas for how to save taxes. I know the learning objectives are here, and some of you have watched the video. How many of you have watched the tax video? Very good, yes, I'm glad you did. There's a lot of detail in there. So we can have a look at the impact of taxes, and I've got my extra notes here, which is very, very important because I want to bring extra stuff that is not in the book. But so far you've been presented a picture where under the Common Reported Standard, under FATCA, there's no place to hide. There's no place to hide at all. You've got to report to banks now, whether you're a citizen of a particular country, if you're from the USA, under FATCA, then you can't hide. Under Common Reporting Standard, you can hide a little bit because you don't have to say which country you're a citizen of, but you have to say which country you're a tax resident of. That's the difference. And as I indicated last week, there may be a bit of wiggle room there. There's a bit of grey area that the Common Reporting Standard is not going to catch. Because you can change your tax residency from year to year to year to year. But once you're a US citizen, boom, you're stuck with that until you do what one of my friends has done, and that is give up his US citizenship. And I told him last year, I said, I got another reason for you to give up your US citizenship. You've got FATCA that's coming along. He said, oh, I didn't know that. I'll put that on my list of reasons. But I still got to give up anyway. All right. So, how many of you want to be a US citizen, by the way? Come on, some of you, just one of you want to be, right? Come on, it's a dream, right? Pardon? You want to have a green card? Because I can give you a green card of a friend of mine, another friend of mine, who gave up his green card. Yeah, the green card doesn't have as much value anymore. And now with FATCA, wow, you're shackled behind bars. You know, you can't hide anything. But at least under the Common Reporting Standard, you have a fighting chance because it depends on your tax residencies. Banks cannot share your information with other countries you are not a tax resident of if you are not a US citizen. So we're going to look at tax planning strategy, VAT very, very quickly, then tax jurisdictions. These are 3 things we want to cover. Exciting, exciting, exciting. Now what about the impact of taxes? There are international location decisions. Often companies locate because of taxation. Apple, many, many, many years ago, over a decade ago, they set up another company in Ireland. And they purposely set that company and gave it ownership rights over some of its intellectual capital. So now it is able to defend its subsidiary in Ireland of being able to actually harbour billions and billions of dollars outside of the US. And they can do that because Ireland has intellectual property rights that it charges its other subsidiaries around the world. You see? Okay, you can't just charge for the sake of charging. You've got to have a basis for charging. The legal form of operation. Are we talking about branch or subsidiary? We're going to talk about that in a minute because often multinationals start off as a branch, then they grow, then they change to a subsidiary. But the taxation effect on a branch is totally different from a subsidiary. Very different. So you need to know if you're giving advice to someone as a branch or a subsidiary, your advice is going to be different. And your advice may be about when they move from a branch to a subsidiary, or whether they should stay as a branch. Method of financing, capital contributions, dividends, loans. Oh wow, this is very, very interesting. Got some interesting things to go through on that tonight, including stuff like bonds, like Apple issued bonds in the US, 18 billion of them, so it didn't have to bring back money from its overseas operations as dividends. To get money out of its subsidiaries out of overseas, they have to pay dividends back home. They didn't want to pay the dividends, but they still need money for working capital back home. So what did they do? They went to the bond market and raised money on the bond market. Okay, capital contributions, dividends is one way of bringing money back to the head office. Interest is another way of shifting money. We're going to talk about dividend interest, royalties, and thin capitalisation, and transfer pricing, which will be next week. Okay, so I'm very excited about this.